Welcome everyone to this episode of Manufacturing Talk Radio. I'm Tim Grady. I'm here with host Lou Weiss. Lou is the founder of Manufacturing Talk Radio. He is also the president of All Metals and Forge Group. They make things like these lovely gears behind us. If you're looking for the gear blanks out of a forging, please contact steelforge.com. Joining us today is Tim Fiore, who's the committee chair from the Institute for Supply Management. He's going to talk to us about the manufacturing report on business, which is in a state of slight contraction, but Tim, it doesn't look all that serious.
Right.
Welcome to the show.
Well, there it is. We got the quote of the show. Right.
Right. Okay. So, in March, all of the sub-indexes were indicating contraction, and it was kind of at that point. I had been carrying a 48 to 52 forecast for the last 4 or 5 months anyway, going into March. And then I think in March, I revised to 47 to 51, and we just caught the low end. So the month of April was a little bit better from a PMI standpoint than the month of March. The demand side was definitely better. There's 4 elements in the demand piece. The new order index, although it's still contracting, it's contracting slower. The new export order number almost expanded, came in at 49 and some change. So we almost hit 50, which is good. The backlog is about the same, eating into the backlog every month because the new order rates are so low. But probably the most alarming is that the customer inventory number just got now to the low end of too high. So that's almost like a whole channel of output that's been shut off to the panelist companies because their customers are saying, I don't really need any more of your product. So, okay, that's a combination of our panelist companies improving their shipment outputs, catching up on overdue, and, the cross collision with their demand probably softening up quite a bit. So that's where we're at. But the demand is better. The numbers in the demand side were better in April than they were in March. Jump to the input side now. I mean, absolutely accommodative. You've got suppliers delivering faster yet again at near records, 10-year plus records, with no end in sight. Which okay, that means they have really soft order books and they have a bit of inventory because they're able to deliver better. I mean, normally everybody likes to build just in time and ship when it's done, but the fact is that most everything goes through inventory for more than a day. So, okay, that's interesting. And then the manufacturing inventory account continues to contract at significant rates, which is disappointing from a PMI number standpoint, surprising from an overall economic standpoint. But okay, you can kind of theorize this thing that first off, they're burning off work in process because they're catching up on overdue. They are clearly burning off finished goods and they're shipping them, and the customers are saying, I got enough. And they're managing that entire supply chain inventory by continuing to not take any more than they can convert. And so, there's 4 elements of that entire supply chain inventory. The first one is off-book commitments, which I think we solved several months ago, the whole over-ordering issue. The second one is manufacturing inventory, and clearly we're positioning ourselves for future lower output, which is good because we're getting ready for it. So it's not a liquidity issue at the panelist companies. The third element is the supplier's inventory of stuff to ship to me, which is their finished goods inventory or semi-finished goods. And that still remains fairly strong because that's helping them deliver on time. And I don't think it's at alarming levels, which is positive. And the fourth element here is really the customer inventory. And we've basically shut that door off to a future sales channel. So overall, the inventory accounts are interesting to analyze what's happening. I'm surprised that we continue to contract on that manufacturing inventory number. And if that thing was sitting at a 50, you'd see the whole PMI number come up at least a point. So, and then lastly here, the output side, I just want to point out to your watchers and listeners that the production number is the best surrogate for billings. Not the new order number. The production number is the best surrogate for billings. So we've been pretty stable on the production number. It's really indicating some decline in billings month over month, but not a dramatic decline. So, and I think if you're looking at when is this sluggishness going to end, I'm not sure that we can have a 48, 49, 50 production number and call this the end. I think we're going to need to see something more dramatic, which would then drive the employment number, you know, and then it would be the beginning of the end. So you guys know I follow five. I've been following five things, you know, no more than five. They're an indicator of growth in the future. You know, the first one is how many industries, how much percent of manufacturing GDP is contracting at 45 or less. In the month of April, it was 12%, down from 25%, which is very positive. That's good. But the second one is chemicals. When's chemicals coming back? Chemicals is not showing any sign of life, you know, less so than in March, and it's not that far from 45. So we'll see what happens there. That could tip in the 45, and then our numbers under 45 jump up to 25 to 30%. The third one is transportation disruptions and price growth. No signs of any of that. Ports are working well. Road freight's working well. Prices are stable, if not declining. Even with any kind of energy surcharges showing up. The fourth one is the hire to fire ratio. We're still operating below 2. We're at 1.7 in the month of April, 1.3 in the month of March, 2 to 1 for the prior 6 months. So we're still, compared to the prior 6 months, we're still looking to get rid of more people than we were. I guess that's the point I'm making. When that hire to fire ratio jumps back up to 4 to 1, then we're starting to expand again. We're definitely not expanding. And in that vein, we can talk about a little bit about the quits rate. The quits rate was the lowest comment level percent since I've been counting it since June of 21. So people are not as likely to quit as they were for the last year and a half. And I think that's all really about the uncertainty in the market that people are concerned. So I think, and the last one's lead times. Although our data, our numbers aren't supporting this, the comments are supporting the fact that lead times are coming down, and that's a positive. So in the month of March, of the 5 elements that I was tracking, only one of them was positive. In the month of April, 2 of them were positive, but we got a long way to go.
There's some pretty interesting numbers there, and I'd like to mention a couple from All Metals and Forge Group, which is my primary business, that kind of support a lot of the things that you said. For example, this month, our bookings have contracted, and our production and billing has gone up. So that supports your numbers. And as far as our backlog, it only went down a little bit, hence the billing. But from last month, we had more new business, and I guess that reflected in the new order, the backlog, and ultimately into production and billing. So we've had an interesting up and down, and not overly concerned. I was actually betting here in our offices that I was betting on a 45 number. So it came in as a shocker to see 47.1. So Tim and I were talking before the show, and he's saying, well, that's kind of interesting. It's up and down and up and down. And I say, yeah, but what it really means is contracting at a slower rate, not that it's going up. It's
Right.
just contracting slower.
Right.
So not to confuse our audience and listeners, it's not terrible.
No. I've been, because of the pandemic and the big suspicion that has thrown on seasonal factors. I track the non-seasonal too, just to keep an eyeball on it. And, we had a lot of derating in the 4 sub-indexes in the month of April, because it's generally a strong month. And if you take the derating out, the seasonal factors, we're almost at a 49.
Really?
Yeah, which is pretty close to 50.
Yeah,
So
we'll take a
47.1 with an almost 49, which almost is 50. Nothing like rounding up from 47 to 50.
Well, my point is that if you take the seasonal factors out, you're close to 50. I mean, it's okay. So it brings you into the whole question here about, is a soft landing good or is a hard landing better? And I just got off a couple of calls this morning, and I'm arguing that this soft landing has thrown so much uncertainty into the environment that we're not really sure what the future looks like. And that future obviously is going to impact capital investment first, for sure. And it'll start to impact employment when, we don't have the work to work on. And the work to work on is really reflected by the production number, because I don't think anybody's building a whole bunch of finished good inventory. They're whatever they're building, they're shipping. And now we have their customers saying, I got enough. So it's going to be interesting to see now what all this brings, because, I do measure sentiment, positive to not so positive, every month, and it's demand sentiment at the headline level. And for the first time in a long time, we're at 1-to-1. So as many people are not as optimistic about the future as are optimistic about the future. And that's a huge shift. I think if we go back on this thing, and I don't want to mix apples and oranges, but in June of 2021, we were 16-to-1, and now we're at 1-to-1. So that's a huge change. We were 2-to-1 pretty much last month, and we pretty much last month in February. So, there's definitely a feeling that we're not sure about the future, which brings in the whole conversation here around the forecast. So we're releasing our forecast next week. Our panelists are going to try to do their best prediction of the rest of 2023, and they're going to do estimations on what actually happened in the first 6 months of 2023 too. So that's a really key point here. Consistent with the fact that we're now at a 47 and some change. What does the forecast look for the end of the year? For your listeners and watchers' benefit here, we had predicted in December that the first half of the year would be lumpy, second half would be dramatically better. In the last couple of months, the feeling based on the PMI is that second half is now probably the last quarter or the last quarter and a half. So we're probably not going to see any decent recovery here until mid Q3, if not the beginning of Q4. And I think that rationale remains. And this is all really around the uncertainty of a soft landing. If we had a hard landing, meaning interest rates at 8%, slamming everything down, everything would be down, then you'd fight your way through that for 9 months, and then you start to grow again. But this is the price for a slow landing is uncertainty, and you guys know businesses do not like uncertainty, although they probably like uncertainty a lot better than recession.
Right.
Yes, an uncertain recession is better than a certain recession.
Yeah, recession is just so certain.
There is one sector I'd like to mention, because we deal with All Metals and Forge deals in this area, and that's the machine shops, which there are many machine shops in this country, small, medium, and large. One of the things I think that they don't go along with some of these numbers, because everything that they do is for the most part custom. So it's not like that they're producing the same part month in, month out, where they need inventory. So there's a lot of what they do, and I'm not sure what the percentage is versus long-term agreements versus contract machining and contract orders that they get an order today and they got to ship it next month. So therefore, they've got to go out and buy the inventory today for next month's shipments, which really doesn't reflect into your numbers.
What do you mean? I mean, you're talking about serial production versus job shop stuff.
Yes.
Tell me more.
Well, the point is that you're saying inventory is too high. Well, a machine shop, he's getting an order today, but he's got to ship next week or next month. So it's not like he has inventory that he can use for new contracts. He's always buying inventory for whatever he's making for the contract today for next month, instead of buying inventory today for a long-term contract 4, 5, 6 months.
Yeah, it's going to depend on the company, obviously.
Yeah, of course.
And a lot of the machine shops, they stock steels, stainless, and non-ferrous aluminums. They stock bar stock and stuff, and they're not. If they're doing job shop work, they're probably not buying mill runs, but some are. So it's a big mix. You're right.
Yeah,
it's one of the largest small business areas in the country is machine shops, and some of them are job shop, some of them support serial production, depends on who the customers are.
Right, right.
And, some build to stock, some build to order. And you're talking about the build to order guys.
Correct.
Yeah,
And there's a lot.
I can't really give you an assessment of the percent of machine shops that are built to order versus built to stock and then ship from inventory. But my point here is that manufacturing inventory is down, and that customer inventory, the customers of our panelists are indicating that the amount of our inventory that they have is too high.
I'll do some research on that, build to ship versus the other.
Yeah, build to stock versus build to order. Yeah,
I'll look into that. I'll get back to you.
That's a fun discussion.
Yeah.
I've
Okay.
worked both.
All right. We appreciate your joining us today, and I know that you've got probably a line out your door to give your insight to other media groups. Tim?
Just want to get one more question in, Tim, before you have to jump, and that is pricing. Are we at the point yet where the purchaser of raw materials can say, whoa, stop at the price increases, we're going to hold, we're not paying it? When do prices abate?
I'm glad you brought that up. We went through 3 or 4 months of price declines, contraction, actually. Okay. And that was remember, we started the year thinking that we'd be about 2.8% price growth into June. And by the end of the year would be at 2.4% price growth from December of last year. So now we're sitting here, with our panelists reporting higher prices in the month of April, and in the month of March, 49.2. That's really close to. So it's almost, and it's primarily steel, plastics. Plastics is hard to understand why that would be, because natural gas feedstocks have been low for 3, 4, 5 months. So why are plastic costs increasing? I'm not really sure why that would be. I don't think there's been a lot of transportation disruptions or a lot of impacts because of climate, in the Texas plastics area. So we do have some increase on the copper side because of China reopening, but China is kind of sagging again. So what's driving the price increase? I can tell you that it's not energy, and it's not the the OPEC plus statements last month that we talked about taking capacity out, which would drive prices up. It's not that. So it's primarily steel, and steel, because steel mills are taking capacity out. It is the springtime, and usually you do turnarounds and stuff in the springtime or in the fall. You don't do it in the mid-season. And I would, spring, February would be the springtime. So there's capacity coming out, which is keeping prices up. I think steel is probably $1,000 a short ton. Historically, it should be 600 to 700, and that's probably contributing. So it's not a good thing. I don't think if you're a person who's looking for the bottom here, supporting the Fed, trying to get to 2%, this is not a very great report. It indicates that things are pretty stable on the output side. Order rates are continuing to decrease. Backlog is being burned off, but prices are on the increase, which you think lead times would come down, prices would come down as demand comes down, and we get back to that normal of demand drives supply and so forth. We're now in a period where we're reporting price increases in a declining environment, which is what a lot of people call stagflation. So we'll see what the month of May brings. I mean, that prices number going up was a bit of a disappointment. The report would have been a lot cleaner without that number going up.
No doubt, no doubt. And for next time, something to think about, Tim, I'd like you to maybe get back to us on. If we eliminate fossil fuels, particularly oil, what happens to chemicals and plastics?
Well, in the U.S., most of the chemicals and plastics comes from natural gas. Yeah, the feedstock is natural. The feedstock is natural gas, and
okay.
Yeah, it's not oil.
Well, that'll be interesting to see what happens to that over the next 10 years. But
yeah, we're back down below $3 in MMBTU, which at the peak here back a year ago with Russia invading Ukraine, I think we got close to 7. And that's 7. And remember now, we're less than $2 MMBTU, and we're exporting a lot of LNG. So, and I think we're now the number one fossil fuel producer in the world, I believe. If you take petroleum and you take coal and you take natural gas, we're number one. So that whole European market, I think that was our number one market in 2020, second half of 2022, and it hadn't been a big market for us before. So we're helping the situation out in Europe, and I think that was actually a good move, because if Europe had seen the pain that they had projected with extremely high energy costs, it could have driven the whole world into recession. And at this point, there's no sign of that. We're just coming off a GDP in Q1 that's positive, 1.4 or something like that. I mean, wow. I mean, following up on a 2.6 or 2.8 in Q4. So there's no recession, but we're definitely in a slowdown mode in the manufacturing side. But we're still, we're back in that 47 to 51 range, which is a really slow slowdown.
Well, it's good it's not 43 and 44, Tim. We appreciate you coming on to explain the report. Want everybody to go to ismworld.org to get the report, or come to Manufacturing Talk Radio and check it out. Thanks again for being with us.
All right. Thanks, everybody. See you next month. Or I think we're going to have a conversation around the forecast, I think.
Absolutely. That is
we
big
are.
stuff.
Yes, we are.
Okay. Look forward to that. Thanks, guys.
All right. Thank you.
See you now.
Want to thank everyone for being with us for this episode of Manufacturing Talk Radio. If you like what you're hearing and you're on something like YouTube, please subscribe, share us with your friends. You can also find us on iHeartRadio, iTunes, Spotify, and any of your favorite podcast listening platforms. Once again, thanks for being with us on this episode of Manufacturing Talk Radio. Good to see you again, Lou.
Same to you. Bye now.